Last week we saw the S&P 500 continue to climb to new all-time highs, and we see the majority of stocks here that in fact continue on that upward trend, although there are some industries that unfortunately did suffer last week. The healthcare sector, we saw massive drops. UNH down 5%, ELV 14%, CVS down nearly 10%. So it is something just to keep an eye on. As the market does progress, there will be some industries that we could see some great opportunities to buy. And we also need to be a little bit wary. We have now moved into extreme greed. So it is something just for a word of caution, as market sentiment can change very, very quickly. And we do in fact have massive earnings that is taking place over the next few days and really kickstarting what we do believe to be a very volatile time, especially with the US election only weeks away. Now in today's episode we are running through some massively undervalued stocks that we do believe have the potential for some insane gains over the next few years. We're going to talk about each one and look at their historical performance. We're going to dive into each one's earning expectations. We're going to see how their record has been over the last 4 quarters, and we're also going to get into the meaty part of these companies, looking at their metrics, not just their dividend safety, but we're also going to take a look at dividend yield theory, look at see how their forward P compares to the 5-year average, and also some very important metrics like the free cash flow, like their ROICs, and many others that we do believe deserve your attention. And as always, we're going to run through each one in our valuation model, getting to not just our own intrinsic value. We also want to get to what is our margin of safety, 10, 15, 20, 30%, and also discuss how bullish Wall Street are on each of these stocks. As we said, some of these have a massive upside, which we really truly believe deserve your attention, and we'll also point out some of these as we do hold them in our own portfolio as well. Now, there are a few things that we want to highlight that did take place just last week. The first one was very interesting. ASML, they were due to report to the market, and in fact, by error, they actually reported 1 day earlier, and it was actually very, very poor. Unfortunately, as we can see, they lost around 50 billion in terms of market cap. And the main thing that we really want to highlight with this company that unfortunately the market did not like, and no surprises there, their net bookings for the quarter was 2.6 billion euros, and that came in massively under what the market was expecting of 5.6 billion. So we have to be wary with these companies that have very high valuations. If they don't hit on what the market anticipates at the bare minimum, and in fact either maintain guidance or increase it, we will see drops to the share price, which, as we are going to discuss today for ASML, could be reasons to consider these in the portfolio. We also saw CVS, they replaced their CEO, something that we actually looked in detail. Their share price did close around 6% on the day, something to bear in mind if you are a shareholder or this is a company that in fact you do want to consider. It does offer a yield right now of around 4.5%. We can also see good news for the UK as inflation was down, which was a very good surprise. In fact, it was 1.7% to the year in September, which is the lowest it has been in 3.5 years. And for those that do like to look at graphs, we can see it is also lower than the 2% Bank of England target. So we are expecting in the UK interest rate cuts to come next month and potentially in December as well. Now let's jump into one of 8 undervalued stocks that we are going to be talking about today. And the first one we're covering today is ASML. As we said, their earnings did leave a lot to be desired by investors, and essentially they are a Dutch company. They design and manufacture photolithography machines, which are very critical for producing semiconductor chips, and we can see they are still up around 24% over the last 12 months. Over the last 10 years, they still massively outperform the S&P, up 633%. Right now, they're sitting towards the lower end of the 52-week range. They have a yield that is near the 1% mark and a forward P around 34. We are going to compare that, as we said, against the 5-year average. And we also note a double buy rating from Seeking Alpha and Wall Street with a hold currently from Quant. So in terms of moving forwards, they are still expecting double-digit growth to their earnings per share year on year, which is always great to see, especially after the disappointing news we heard. But we also note over the last 4 quarters, they still have outperformed analyst targets and quite substantially, which is always a great sign, 100% giving us that confidence that in December 2025 the EPS estimate of 26.72 will be hit, lowering that forward P to around 26.22. Now jumping into some of their metrics, dividend safety score 82, very safe, always good to see. We're going to discuss dividend yield theory as well as the undervaluation on the forward PE, but we have to say we are disappointed about the dividend increase this year at 4.8% because it's only marginally above the inflation rate of 4%, but also they have historically increased those dividends at a very rapid rate. We also note they have reaffirmed at the beginning of August this very safe score, which ultimately means a dividend cut for ASML is highly unlikely. For each one of these 8 stocks, we are going to take a look at key metrics, which essentially were how they performed during the Great Recession 07-09. ASML unfortunately cut the dividend, didn't maintain it and didn't increase it. They had below average growth, negative 56%, S&P was negative 12, and they also had a near S&P return, negative 55, as we can see the S&P itself, negative 55. Dividend growth, we already mentioned, disappointed about the increase that we saw this year, as over the last 5 and the last 10 years, they have been increasing these dividends at a very strong rate. In fact, the last 10 years, 26% year on year on average. They have also been increasing those dividends for the last 14 years. Now, based on the forward PE, what we're taking a look at here is essentially this blue tunnel, which is the expected intrinsic value. Right now, and in fact for the first time, or in fact not that often over the last 12 months, we are seeing it below that expected lower end of the fair value, giving us a massive undervaluation signal. But as always, we are going to look at our own intrinsic value ourselves, which will give us the same conclusion. But as we said, we will take a look at our own valuation model. We also note on dividend yield theory, this states the company is undervalued when the current yield sits above the 5-year average. There we have an undervaluation signal, 0.91 versus 0.83. We also note, based on the forward PE, it is sitting at 29.1, which is again lower than the 5-year of 34.1, another undervaluation signal. But we do note it still is higher than the information technology as a sector. But remember, as always, we don't look at any one of these models in isolation. And importantly as well, some companies do deserve a premium to the overall sector. Question is, does ASML deserve a premium? The second question we have to ask is, how much of a premium? Something we will take a look at. As always on this channel, every metric we look at will be the free cash flow over the earnings. Remember, earnings data is susceptible to manipulation by management through accounting, and below 50% is what we want to see for this industry. We see it every single year, bar 2023, which is the reason why we did get that very poor increase. Nice to report, over the next 12 months is anticipated to come down to 14%, so we would expect ASML in 2025 in July to give us a nice double-digit growth. In terms of the free cash flow, and something we do need to point out with ASML, it is in the semiconductor space, which is cyclical, therefore we do expect peaks and troughs. We still note it has increased at 153 in 2014 to 825. Remember, for this metric, we want consistent increases over the long term. Not something we get. We do get an increase, but we also point out that the highs of 2021, it has subsequently come down over the last 2 years, but we are pleased to say over the next 12 months, it is expected to continue and at a very rapid rate. In terms of sales growth, well, 3 to 7% is what we want to see. At a bare minimum, the 3 to 4% just to keep up in line with inflation. But we notice pretty much every single year, double-digit growth to their top line. 30% in 2023, which is a very good sign. And we note when we look at it from a numerical perspective, their total sales, it has climbed very, very sharply. In fact, more than 4 times from 5.86 billion 10 years ago to 27.6 in their latest annual report. Now, shares outstanding is something we focus on. We want to look at companies that return excess cash to shareholder pockets through those share buybacks, and we do note ASML have bought back roughly around 10% from 2014, which is always a nice added bonus on top of those double-digit dividend increases they have historically done. Now, in terms of ROIC, our most important metric, above 12% for this industry, giving us faith management are able to effectively allocate their capital, and we notice they've done that every single year. Last 3 years have been phenomenal in the 40%, and 49% in 2023, even with the drop on the trailing 12 month at 37%, still gives us faith this company is absolutely phenomenal when it does come to their returns on capital. Now, operating margin, when we go through these companies, ideally what we want to see are operating efficiencies. Obviously, we want it above the minimum expected, but also increasing over the longer term. Something we see from ASML, 26% in 2014, 33% in 2023, so always a good sign. High quality companies will always do those two things. And we also want a company with free cash flow margins above 5%. Again, whilst we do get inconsistency on this metric, they still deliver above that minimum level. Finally, we get the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, below 1.5 for semiconductors. The numbers below, or in fact the lack of, are the number of years that it takes the company to pay off all of their debt net of cash on hand. And this metric correlates to both dividend safety, balance sheet strength. Over the last 10 years, it wouldn't even take this company one day to pay off all of their debt net of cash on hand. Over the next 12 months, 0.02, so still very, very low, indicating their balance sheet is looking very, very strong, and always a great sign, something we do love on this channel, and we do believe it is important to consider when you do look at companies. Now we're going to jump into the valuation model, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, how we got to ASML's valuation? Well, for this company, it was the DCF model. We're not going to run through every single model today. We are just going to look at it from an overview. But for ASML, as it is just, we have the free cash flow year on year, we have the average growth rate at 35%, and in today's episode, we have gone from a growth rate of 30%. As we can in fact see, that is lower than the average growth rate, and in fact lower than what the analysts do estimate in the semiconductor and AI space. They believe over the next 10 years, it will be increasing around 40% year on year. So with the 30% and the discount rate of 8%, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, intrinsic value giving us around 59% upside. Now remember, these numbers are subjective, and you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for ASML or any others that you do desire. Now, for full transparency, we will show you, for those that believe it should be lower, at 25% we can see an intrinsic value of $826, giving upside of 14%. For those that believe it should be higher and in fact in line with the average over the last 10 years, at 35% at $1,580, this means 118% upside, indicating more than double from the current price. As we said though, we will take the 30%, which is essentially the median rate today, and this gives us our intrinsic value, of which on this channel we always like to do a margin of safety, 10%, which we execute on if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, a buy in today's episode at $1,033, and then we keep going until it's near the current trading price. And what we can see in today's episode for ASML, you are in fact getting at least a 35% up to $746. At 40%, you would need to wait for $689. So 35% MOS, and Wall Street, as we said, very bullish. Their price target of $1,153 does indicate 59% upside, and that is just over the next 12 months. So let us know your thoughts about these stocks as we go through them today. 35% MOS with, as we can see, Wall Street indicating 59% upside over the next year. Now, today's episode is sponsored by Snowball Analytic, and this is essentially a portfolio tracker, but it does a lot more. For example, when we have a dummy portfolio here, it shows you your investment value. We can, for example, see the split of the different sectors. It also shows you what have been your best companies over the last day. It also keeps you up to date with what is going on, in particular with your stocks. It also highlights your future payments every single month, so you know when your dividend income is coming. Now, we also can see in a bit more detail the dividend income, showing us the yield payouts, also showing us the safety of each of these. We can also see the growth for each of these companies. So for example, the average annual growth for Nvidia sitting at 16%. And one cool factor is that you can compare your portfolio performance against the S&P. You can also look at individual stocks. So for example, Johnson & Johnson, we have data here on the right, especially for people who are focused on the dividend. Again, very easy to understand, very easy to consume. The user interface is on point. We also love the fact that you can take a look on a month-by-month basis of when dividend payouts are. There is also a 14-day free trial period, so check it out. The next stock we're moving on to is Novo Nordisk. Now, this is a global healthcare company. They're based in Denmark, and they focus on developing and manufacturing treatment. Now, this is for diabetes, obesity, as well as many other chronic diseases. We get a double buy rating from Seeking Alpha and Wall Street. We get a hold from Quant. Now this is trading in the mid to low end of the 52-week range. It has a forward yield of 1.22% and a forward PE sitting just below 36. Now over the last 12 months, it is up around 17%, although we can see it has pulled back significantly from the 52-week high of 148. And over the last 10 years, it has significantly outperformed the S&P, up 417%. Now they did miss their more recent earnings by around 7 cents, but we still note they anticipate over the next 2 quarters double-digit growth to the EPS year on year. And when we look back out of the last 4, they have outperformed 75%. Just unfortunate they did miss on the recent quarter, but if you still have faith they can hit their full year December 2025, their forward PE will come down to around 28.9. Now taking a look at their dividend safety, 99, very safe, in fact the highest score obtainable. We're going to cover these metrics, but we love the fact they increased their latest dividend at 52%. In terms of the last recession, well, unlike ASML, they increased the dividend during the 07-09 crash. They had above average growth and they also outperformed the S&P negative 27%. In terms of dividend growth, we already said massive growth over the last full year, but it is something they do on a very continual basis, 21% increase year on year over the last 20 years. They're also a dividend aristocrat with more than 25 years of consecutive increases. Now in terms of the valuation based on the forward PE, what we get a sense of here is over the last year, they've actually been trading above the expected price. Only recently have they come into that, which is interesting. And again, we'll consider that in our own valuation model. Based on dividend yield theory, as well as the forward PE, given they aren't too far off the 5-year rolling, you could argue based on that, they do look to be reasonably valued. We can see it is significantly higher than the healthcare sector as a whole at 16.3. Now, in terms of their free cash flow payout, below 60% isn't something we see year on year. In fact, it does straddle around that, but nice to note they can still offer those double-digit increases. Over the next 12 months, this is expected to come down to 53%, which is a very good sign. In terms of the free cash flow per share, well, it has been increasing, in fact, tripled over the last 10 years and anticipated to continue over the next 12 months to 1860. Always a great sign to ensure companies can continue increasing free cash flow. We then look at their sales growth. While there are some years where it has been flat, over the longer term, it does look very strong, including the last 3 years, 28% again on a trailing 12 month, indicating the revenue growth isn't expected to stop over the next year. And when we look at it from a numerical point, it has tripled over the last 10. They've also done returning of excess cash to those share buybacks, so always a good sign, as we saw with ASML. And in terms of ROIC, one of the best that we have seen on this channel. Just look at these numbers on a year-on-year basis. In fact, their worst year in 2021 was at 58%, more recent year sitting at 72%. Margins also looking absolutely fantastic, above 12%, and in fact increasing over the longer term. So do understand there are reasons why companies do trade at a premium. Doesn't mean you should buy them, but it does mean in fact they will be trading higher than this overall sector. We also note free cash flow looking absolutely gorgeous, a free cash flow machine. Finally, when we get to the net debt to EBITDA, as strong as ASML, it wouldn't even take them that long to pay off all of their debt net of cash on hand. So a very strong balance sheet, and as we said, dividend does look to be secure. Now our intrinsic value in today's episode at $134. When we take a look at it in terms of the margin of safety, at 10% a buy at 120. It isn't at the 15% MOS just yet at 114, but not too far off. So sitting between 10 to 15% in today's episode. For those that want 20%, will it buy at 107. For those at 25% at the $100 mark. But as we said in today's episode, at least 10% up to 120. Wall Street though, they keep increasing their price targets. They now see $154 over the next year, giving this 31% upside. And as we said, do give us your thoughts in the comments below. We also want to let you know we have released our latest free weekly article. We deliver one to your inbox every single Monday morning, where we take a look at what's happened over the last week in the market, as well as stocks that we do believe deserve your attention that look to be undervalued. So do click on the pinned comment below, sign up and read straight away. You will also be able to gain access to 36 undervalued stocks that we believe are considerations in the overall market. And we run through a lot of information, also what Wall Street see in terms of the upside over the next year. And we also flag those that sit within our own portfolio. And this month you can also grab 22 undervalued stocks that Wall Street themselves believe have the most upside in the S&P 500. So as we said, click on the pinned comment below, sign up, and you can read straight away. The next stock is Microsoft. Now it does need little introduction, but it is a global tech company. It develops, licenses, sells software, hardware, cloud services, and ultimately they are best known for products like Windows Office as well as Xbox. Now we have a double strong buy in today's episode of Wall Street and Quant. We also have a buy from Seeking Alpha, and this is trading in the mid to upper end of the 52-week range, but has pulled back from the 52-week high of $468, and it has a forward yield of 0.08%, a forward PE of 31.69, and over the last year it is up 27%. Over the last 10 years, it has massively outperformed the S&P, up 806%. In terms of their earnings, well, they are as consistent as they come, anticipating double-digit growth of 3 of the next 4 quarters. Q1, so when they are due to report soon, anticipating around 4%, and over the last 4 quarters, at a bare minimum, they are beating analyst expectations, sometimes by a very nice margin, sometimes like the previous quarter, just by 1 cent. Now that does give us faith they will be able to hit their June 2026 target of 15.3, which will lower the forward P to 27.24. In terms of dividend safety, well, 99 very safe like NVO, and we also note a double-digit increase to their dividend just last month. In terms of looking at the last recession, well, they maintained the dividend, didn't increase, didn't cut. They had a round average growth at -8%, and they marginally outperformed at -48%. As we can see, and as we already mentioned, this company is pretty much as consistent as they come. Double-digit increases are pretty much expected every single year, and they've been increasing those dividends for the last 14. Now, in terms of looking at the valuation, in terms of the forward PE, we do notice this isn't a company that pretty much trades at a cheap valuation that often at all, but right now, based on this model, does look to be trading at the midpoint of the fair price. In terms of dividend yield theory, well, we can see not too far off in terms of both yield as well as the forward PE, so we could argue reasonable valuation. Although similar to previous companies today, it does trade higher than the overall information technology sector, but we do believe with Microsoft it is significantly worthy of a premium to the overall market. Free cash flow payout below 60%, that is what we see every single year, in fact decreasing 30% in 2024, 33% over the next 12 months, so no surprises, another double-digit increase expected next September. We also see consistent increases to their free cash flow, more than tripled over the last 10 years, expected to continue that upward trend over the next 12 months as well. And we also love the fact that their revenue is also very nice to see, nearly double-digit increases every single year, 16% in 2024, and again we can see nearly tripled from 2015's 93 billion to 245 in 2024. Now, in terms of doing share buybacks, it isn't something they consistently do. In fact, just over the last 2 years, we see no movement. But again, it is something that is a little bit of a bonus, but don't anticipate it continually with MSFT. Now, in terms of ROIC, looking very strong, not as good as NVO. As we pointed out, that is a fairly rare occasion, but nice to see in the 30 percentage points over the last 4 years very consistently. We get definitely here a high quality company, not just increasing revenue, but very strong operating efficiency, and the free cash flow margin, well, this is definitely and very clearly a free cash flow machine. Again, pretty much the third company we've looked at today with a phenomenal balance sheet. No surprises, all 3 so far very safe dividend scores. But look, for the large part, it wouldn't take them that long at all to pay off all of their debt net of cash on hand. Now, in terms of our intrinsic value at today's episode, $470, and with our margin of safety, well, 10% a buy at $422, 15% not quite there yet at $400. Now, with this company, you are getting a 10% MOS, but a lot of people do like to just dollar cost average into very high quality companies when they do hit around the 10% point, even 5%, and I know a lot of people do like to pay a premium. In my opinion though, 10% MOS, dollar cost average, or waiting for around the 15% point is something to consider. At $400, we can see that 15 point. 20% around 376, and we're just doing this to show for those that are interested at 25% 352. Having said that though, we know Wall Street are very bullish, their price target over $500, and they see 21% upside for a very strong company in not just the S&P but in the Mag 7. As always, give us your thoughts below. We then move on to Rio Tinto Group. Now this is a mining company which produces and supplies metals and minerals. We have a strong buy from Wall Street, a buy from Seek Alpha with a hold from Quant. This one trades in the mid to lower end of the 52-week range, a nice forward yield of 6.7%, a forward P of 9.3, and over the last 12 months up 5%. Bear in mind, like semiconductor space, this is a cyclical industry. Over the last 10 years, up around 32%. Now, in terms of looking at their earnings per share, we want to point out here that for the full year this year, in fact, they anticipate 7. Next year, they are anticipating this to drop, therefore increasing their forward P to around 10. And the same to be said for their revenue. They are expecting a very minimal drop from that 52.82 billion anticipated for December 2024. Again, remember this is a cyclical company and we do get in fact a unsafe score of 40, so we just want to point that out, but we will run through essentially looking at this company and their metrics. So let's firstly digest this information. Essentially it was reaffirmed on the 14th of August, which means there is a moderate to a high risk of a dividend cut over a full economic cycle. Now, what did they do in the last recession? Well, they cut the dividend, they had below average growth, and they also trailed the S&P negative 71%. We noticed in terms of dividends, well, negative 11% over the last full year, but still over the last 5 and the last 20 years, they have been increasing it at a very nice rate. In fact, we noticed 0 years of consecutive increases. This is definitely one though to consider if you are someone that does like to use that dividend yield for other expenses. In terms of looking at though over the last year, we do notice it has been trading essentially above the fair price. Right now we see it pretty much right there at the top end. Although when we do take a look at dividend yield theory, we do notice it does sit below at 6.64 and the forward PE sitting marginally higher at 9.6. Cheerios as a whole in terms of the sector PE does sit much higher at 21.9. In terms of the free cash flow payout, well, it has been increasing. Below 40% is what we want to see for this industry. 87% in 2023, 103 over the next 12 months. So do anticipate with this yield, it may not stay as high as often, but this is a company that has historically decreased their dividend, but then also increased it at a fairly attractive rate. In terms of free cash flow over the longer term, we do see increases, but we also see inconsistency, but nothing really there to shock anyone. This is a mining company. We do expect a lot of inconsistencies, a lots of cyclicality year on year. Over the next 12 months, we are anticipating a drop to $4.21. In terms of sales growth, well, 5 of the last 10 years have been negative as we get that cyclicality shown through the numbers, but we get some very strong years followed by some very low years, and right now in 2023, negative 3%. On a trailing 12-month basis, this is expected to pick up 3% to their top line. From a numerical standpoint, we see 48 billion in 2014, 54 billion in 2023, and whilst they have done share buybacks over the last 10 years, we do notice the last time in fact they bought any shares back was in 2019. As we can see here, the 19 to 20 movement, very minimal, but nonetheless just something we want to point out. ROIC for mining companies, we say around 8%. We get that pretty much every single year, looking very high over the last 3 years. And when we look at the margins, we do get that inconsistency, but what the key thing to understand here is we want it above that bare minimum level. 28% in 2023 is still very strong as an overall perspective and in comparison to the sector overall. Free cash flow margin as well. There are certain parts to like about this company, and it will really depend. A lot of investors actually want to see companies that have very high yields. And in terms of net debt to EBITDA, whilst we do get that unsafe score above, what we notice here is it is below 1.5, 0.25 in 23, 0.29 over the next 12 months, and has been below that every single year. So we do believe that dividend does look to be secure over the long term. Whilst you may get fluctuations on a year-on-year basis, it still does look like one that will continue to pay out dividends over the foreseeable future. As always though, definitely something to consider looking at on a quarter by quarter, year by year basis. Now in terms of our intrinsic value, we get just under $80, and when we run it through the MOS at 10% a buy at 72, at 15% a buy at 68, and in today's episode you aren't too far off a 20% margin of safety. Maybe that is sufficient with a company that pays an attractive yield. Maybe you want more. Again, at 25%, $60, at 30 you can see around 55, and for those that want 35%, around 52. So in today's episode we see a 20% MOS, And as we can see, Wall Street very bullish on this company, nice yield, 28% upside, $84 price target. So again, might be something to consider. Do give me your thoughts. Maybe this is one you like, maybe this is one you actually don't like. But as we said, always nice to bring up some variety on the channel. We then move on to Lam Research, another one that had a little bit of a struggle with the ASML earnings. We have a double buy rating and a hold from Quant. This company essentially designs and manufactures equipment used in the production of semiconductor devices. For those that want to know the nitty-gritty detail, this is specifically in relation to the water fabrication process. Now we do notice it's trading towards its 52-week lows. It has a forward yield of 1.26% and a forward P above 20. Remember, S&P right now around 25. Over the last year, up 13%. Over the last 10 years, outperformed the S&P, up 864%. We do like the fact that over the next 4 quarters, they do expect double-digit increases to the earnings per share. And when we look back over the last 4, they have also outperformed analyst targets. 4.4 is the expectation for EPS, lowering the forward P in 2026 to 16.61. Now, dividend safety 66, so it's nice to see a safe score after the previous company, and we can in fact see double-digit growth to their dividend in August this year. So let's take a look at their key metrics. So they didn't pay a dividend, so no comparative data in the recession. We notice below average growth, negative 55%, and we can see they did trail the S&P, negative 64%. As we said, nice dividend growth this year, but also over the last 10 years where we see 46% year on year. We also note 10 years where they did consecutively increase that dividend. Now, in terms of taking a look at this valuation model, we can see for the first time, or in fact since November 2023, it is trading at the lower end of the expected bucket. Always a good sign to initially look for undervalued companies. And we also can see that the yield, although marginally it is above the 5-year average, the forward P not too far off, so reasonable valuation based on these models. And we can see it is in fact lower than the sector overall at 25.1. In terms of free cash flow payout, always great to see, below 50% every single year, 25 in 24, 28 anticipated over the next 12 months. So we would be surprised if we don't see a very attractive dividend increase. In terms of free cash flow, well, increasing rapidly over the last 10 years, although we do anticipate a slower increase over the next 12 months. And when we do get to the sales growth, remember this industry is cyclical in the semiconductor space. We notice the more recent year has decreased by 14%. Nonetheless, when we do zoom out, it still has tripled from 5 billion in 2015 to 15 in 2024. We then move on to these shares outstanding, where we do see the net effect over the last 10 years has been share buybacks, which they have done over the more recent year at a very, very consistent basis. Although marginal, do not discount this effect. It is nice to see as an investor. And their ROIC, like the majority of stocks today, are looking very, very strong, 31% in 2024. Operating margin, we do get that sense of operating efficiency, 17 in 2015, 29 in 2024, and the free cash flow margins looking very, very good. Net debt to EBITDA, again, balance sheet looking absolutely phenomenal. And even though Rio Tinto, as we saw, may be a little bit weaker in terms of the metrics, including that company, every single one so far has had a very, very strong metric in relation to net debt to EBITDA, indicating very good balance sheet. In terms of the valuation of Lam Research, well, our intrinsic value of $101 isn't dissimilar from Wall Street's 103, where they see 41% upside over the next 12 months. In terms of MOS, well, 10% a buy at $91, 15% at $86, at 20% around $80, and we can see in today's episode, like the majority, you are getting a nice MOS, not at the 30% level just yet, around 25%, with Wall Street, as we said, looking very, very bullish. Remember, you can also grab a copy of this model by clicking on the pinned comment below, whether it is for this company or any others, just to play around with the valuations. Maybe you agree or maybe you disagree on some of the inputs. We're seeing a lot of strong buys in today's episode, and ELV is no different, with a strong buy from Wall Street, a buy from Seeking Alpha, and a hold from Quant. It's essentially a healthcare company. They provide health insurance and related services to not just individuals but also businesses and government programs in the US. we have a forward yield of 1.47%, a forward PE just above 12, trading towards the lower end of the 52-week range. Now, we've done a detailed episode this week, so do check that out because they did release their earnings. Over the last year, down 8%, but over the last 10 years, they still, with the drop, have outperformed the S&P 500, and we do notice growth over the next 4 quarters in terms of earnings per share year on year. As we said, they did miss their earnings by quite some distance, hence the drop, and over the previous 3 they did beat, so 75% track record. If you do believe they can hit their next full year EPS estimate, that will lower the forward PE down even more to 11.4. Nice to see a 99 very safe dividend score. We have massive undervaluation on dividend yield theory, undervaluation on the forward PE, and nice to report double-digit increase at the beginning of this year. In terms of the last recession, well, no dividend paid, no comparative data. They had above average growth, but they also trailed the S&P marginally negative 61. We always love to see double-digit growth on this channel. ELV no different, 15% over the last 5 and the last 10 years. And we can also see they have been increasing those dividends for the last 12. In terms of looking at this valuation model, as we can see, for the first time, or pretty much the first time over the last 12 months, this company is trading well below its intrinsic price. We also note here double undervaluation, with the yield being higher than the 5-year and the forward PE being lower than the 5-year rolling at 13.9. We also note it is significantly lower, so effectively trading at a discount to the overall sector. In terms of looking at the free cash flow payout, well, every single year below the 60%, 18% expected over the next 12, so we would expect, like clockwork, another double-digit increase to the dividend in January 2025. We also note that effectively tripled their free cash flow over the last 10 years and expect it to continue to climb higher over the next 12 months. In terms of sales growth, well, yes, we want to see 3 to 7% as a bare minimum, but it has looked very, very strong. Very rarely is it sitting towards the lower end of that range. And from a numerical standpoint, we can see more than doubled from $74 billion in 2014 to $171 in 2023. They also return excess cash every single year, although very trivially, it still does help as an investor on your overall gain. Remember, with share buybacks, it does give you a larger portion of the overall company. ROIC looking very consistent as well every single year in the double-digit range, 15% in 2023, and something that is very typical with this industry, not just ELV, but those margins are very low in comparison to what we want to see. So don't take this as a massive negative. Yes, it isn't great. We do want to see it higher, but as overall, when we compare it to companies like for like, this isn't that far off. We also notice free cash flow margin around that 5% on a year-on-year basis. Net debt to EBITDA, like nearly every single company today, not even one day for them to pay off all of their debt net of cash on hand. Intrinsic value at $567 when we do it through the MOS, while 10% a buy at $510, at 20% a buy at $453, and we can see in today's episode not far off a 25% MOS, but you're getting at least 20% up to $454, with Wall Street very bullish even after they dropped the price target of $585, giving this 36% upside over the next year. We then move on to Merck & Co, where we get a buy from Wall Street, although do notice that isn't far off a strong buy rating, which would be 4.5, but a hold from both Seeking Alpha and Quant. Now, this is a global pharma company. They develop, manufacture, and distribute medicines, vaccines, as well as healthcare products, and it is trading towards the lower end of the 52-week range. A forward yield of 2.81%, a forward PE below 14, and over the last year they are up but only 7%. Over the last 10 years, up around 92%. Taking a look at their earnings, out of the next 4, they expect 3 of them to be positive, although the next quarter they are expecting double-digit decrease to the EPS. Over the last 4, always great to see, they have outperformed analyst targets, and over the next year, essentially 9.72, it will lower their forward PE down to 11.29. Again, the continuation of very safe dividend scores at 90, with an above inflationary increase to their dividend of 5.5% November last year, indicating we are anticipating an increase next month. Now, last recession, they maintained the dividend, they had above average growth, and they marginally trailed the S&P, negative 57%. Over the last 5 years, nice high single digit increase of 9% on average, but over the last 20 years, they have been increasing that dividend pretty much as we see, in line with inflation at 4%, with 12 years of consecutive increases and 53 years of paying a dividend without a reduction. Now, in terms of this valuation model, we actually see it towards the mid-upper end of the expected fair price, but this is a company for the large part of the last year has been trading well above that expected level. In terms of dividend yield theory and in fact the forward PE, trading not too far off their 5-year averages, indicating reasonable valuation, but we can see they are trading at a discount to the overall sector in terms of that PE. We then move on to the free cash flow payout, which has been downtrending, so that is good to see. Not below 60% every single year, 81 in fact in 2023. No surprise then why we got that pretty poor increase to their dividend. Over the next 12 months though, expected to come lower to 37%. Now we see the free cash flow has been increasing over the longer term, but very inconsistently year on year, and in fact expected to more than double to 824 over the next 12 months. And with the sales growth, whilst we do get 3 of the last 10 years being negative, we do notice increases over the last 4. Last full year though, very mediocre at 1%, trailing 12 month at 7%, looking likely to be a strong year in 2024 for Merck & Co. In terms of numericals, they've increased their top line 50% over the last 10 years, and they've also done share buybacks, although very inconsistently, and in fact just over the last year, they did a very small issuance of shares. Then we move on to the ROIC, like most companies today, looking very strong, well above the minimums, in the 20s over the last 2 years, 24% as well on a trailing 12-month basis. And when we get to the margins, well, on the operating side, what we can in fact see here is operating efficiency above the minimum 12%, and free cash flow again looking very inconsistent, but also very strong. Then we move on to the net debt to EBITDA, where we don't get 0 unfortunately for Merck & Co. In fact 2.81 in 2023, but nice to see a massive drop expected to 0.87 over the next 12 months, which is probably why we do get that very safe dividend score. Now, our intrinsic value at $146 will indicate a large MOS in today's episode. In fact, at 30%, it isn't right there yet at $102, but in today's episode, you are getting a 25%, pretty much bang on the current market price. In terms of Wall Street, well, as we saw, they are very bullish, strong buy signal, 27% upside with $138 the expected price over the next year. And as always, give us your thoughts in the comments below. Let us know if you are thinking about or maybe adding any of these in the future. We then move on to Micron Technology, where we get another strong buy rating from Wall Street, a double buy from both Seeking Alpha and Quant. And this company, again, it is essentially designing and manufacturing memory and storage solutions, and these are used in computers, smartphones, as well as other electronic devices. We see it trading in the midpoint of the 52-week range, one we have continually discussed as a strong buy, in fact, when it was trading around $80. We do notice right now forward PE around 12.6 and a forward yield around 0.41%. Over the last year, phenomenal performance, up 61%. Over the last 10 years, outperformed the S&P, up 261, although we do notice it has come quite some way from its 52-week high of $158. Now, over the next 4 quarters, they are expecting growth to the EPS year on year, and when we do look back over the previous 4, they have outperformed management targets, with a massive growth expected over the next full year, lowering that forward PE down to 8.8. Now, in terms of dividend safety, we have our first borderline safe score at 60, and we also want to flag for those that love their dividend growth, this company hasn't increased their dividend in quite some time. Now, what does this mean? Well, it was reaffirmed in July this year that effectively there is a moderate risk of a dividend cut over a full economic cycle, and we also note over the last recession, they had below average growth at negative 18%. They have, though, been paying a dividend without a reduction for the last 3 years, and when we do get to this model, what we can in fact see is over the last 12 months, it has been trading significantly above its expected fair price. Then we get to dividend yield theory, but not something we would consider, only recently started paying a dividend. More importantly, on the forward P at 12.4, it does sit lower than the 5-year rolling at 13.9 and significantly lower than the overall information technology at 25.1. So looking at their free cash flow payout, what we can in fact see, it was very high in 2024. As we said, below 50% is what we want to see. Nice report over the next 12 months, expected to come down to 16%, and something that in fact perhaps we could see in terms of nice dividend growth moving forwards. Again, in this space, it is cyclical. No surprise then, 2 of those years have been negative in terms of free cash flow. 0.11 in 2024, 2.85, so massive growth expected over the next 12 months. And when we get to the sales growth, again, cyclicality shown through their numbers. We notice here 5 of the last 10 years being negative. Massive growth though in 2024 at 62%. And when we see it from a numerical perspective, cyclicality is definitely shown within those numbers. We also notice they've issued shares, they've bought back shares, but very trivial difference from 2015 to the latest quarter. In terms of ROIC, again, cyclicality shown through these numbers. Above 12% is what we want to see. We get that for the majority of the last 10 years, but we notice 2024 at 2% isn't something we ideally want to see. In terms of operating margin, above 16% like we have seen for the majority of semiconductors today, although we do notice the more recent years haven't been the best for MU, and that is why we have seen, in fact, over the shorter term, that share price has come down from the 52-week highs. Same to be said as well for the free cash flow margin. One thing we do like though, their net debt to EBITDA is low at 0.65 in 2024 and expected over the next 12 months to come down to 0.31, so always good signs to see in terms of the balance sheet. Now in terms of our intrinsic value, $138 in today's episode with an MOS of 10%, a buy at 124, at 20%, pretty much where the current trading price is right now. So you are getting a 20% margin of safety with Wall Street, very bullish. In fact, all 3 analysts considering this a buy, 34% upside, and their price target $149. As always, if you did enjoy today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter by clicking on the pinned comment below and joining us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.